Hi everyone. Today we are going to cover the topic called capital budgeting or investment decisions. Before we move on to capital budgeting or investment decisions, let's try to understand an overview of CMA program as a whole. I mean the topic part of CMA. When you look at CMA overall part, you have two parts. One is part 1, other is part 2. And the topics under part 1, you have first is external reporting, external financial reporting, then you have budgeting, then you have costing, basics of costing, then you have standard costing or performance management, and finally you have internal control. Similarly, when it comes to part 2, you have 6 topics instead of 5 here. Part 2, you have financial statement analysis, then you have corporate finance, you have decision analysis, which is also called as marginal costing, some areas of risk, the portfolio management topics are covered under risk, then you have investment decisions or capital budgeting, and finally you have professional ethics. So these are the topics, I could say at a nutshell, at a very macro level for part 1 and part 2 under CMA. And what we are going to focus now is under part 2, you have investment decisions. We will be taking that investment decisions and moving further. Okay, investment decision roughly have around 15 to 20% weightage in CMA exam. Investment decisions also known as capital budgeting. Okay, why investment decision is also known as capital budgeting? See, whenever let's take a very simple example. We keep saying we are going to invest on a property. We are going to invest on a land. So those situations at that moment, you need fund, which is not something where you immediately arrange and settle. It is some fund which is substantial in nature, which requires a long-term decision. I would say time required to take that decision. The impact of that decision may be for a long term. So that is why you may have to think from a capital perspective with respect to the amount of investment, time, etc. required. So whenever you have those kind of scenarios coming in, we call by the term capital budgeting. I will come more in detail because capital is always under constraint, and at that point you need something called budgeting exercise. So that is why investment decisions, when we are saying, we relate that with the term capital budgeting. I hope that point is clear. Yes. Now what we will do is, the topic of capital budgeting, we will subdivide into 3 segments. The first part is basic part of discussion. Then you have different methods, which includes, under methods you have net present value method, internal rate of return, payback period, profitability index, accounting rate of return, like that different methods, and then finally few miscellaneous areas. So I could say the entire capital budgeting into 3 segments: basics, methods, and miscellaneous areas. Now what we will do is, we will start with basics. We'll start with the basic part of discussion. Please remember the flow. Part 2, investment decisions, which is also known as capital budgeting. Under capital budgeting, 3 segments: basic, methods, and miscellaneous areas. Now we are going to go further to the next level, which is the basic part. So when we say about basic, we are going to discuss about capital budgeting. It is important to understand what is capital. See, in economic terms, people call capital as anything which add a substantial economic value to what you are going to do, which we call it as capital in economic terms. Whenever in finance capital being referred, it's generally raised with respect to raising of fund. You need to enhance your potential business, or to start up a business, the funds required, or to kick off a new business. All these terms are related with or could be used along with the term capital. So in layman's language, we could say that capital is something to maybe to kick off a business, or to ensure that the smooth flow of business happens when as and when any additional requirement. It can be in the form of cash or by means. I hope that point is clear. Capital. Now the next is capital again could be classified into two segments. So let me try to give an example on that. Let's take a restaurant business. Okay, we are going to start a restaurant. Now when we look at from a restaurant perspective, if we want to start, what are the requirements? We could classify into two parts. Okay, one is I may be requiring a building, we may be requiring a land, we may be requiring the furniture, equipments, high-end equipments may be required, which we can put it on the right side. On the left side, we could see, the areas, groceries, maybe to cook the food, I need groceries. Maybe I need staff to, run that to make that cooking happen. So I need people for that. Then maybe I may be requiring some vegetables. I may be requiring all miscellaneous items to ensure that smooth functioning of the restaurant, which we can park it as on the left side. Now when we look at the right side, land, building, equipment, all high-end costs, high-end related areas. Second, on the other side, you have groceries, miscellaneous items, staff, etc. When we compare the first side, when we say what is the difference between these two, right hand side and left hand side? If you look at the right hand side items, you could see land or building. It is a decision which we make, the impact of it will be for a longer duration. It will be for a longer duration. I'm going to invest in a building. It is not for a single day. It may be for our next 10 years, 15 years. We are going to invest on a land next 15 years. We are going to buy some equipments. Not immediately. It will be continuously used. On the other side, if you look at here, what are the items? We look at groceries. Groceries maybe for tomorrow, day after, not for very long. So look at staff. I hire a staff. If the efficiency of the staff is not good enough, I may think, okay, we need to think that, okay, that is fine, we can move him out. So as a result, if you make a comparison, one is which is relating to long term, which is for a longer duration. The other one is relating to a shorter duration. So the first one, we call it as long-term capital. And the second part, we call it as short-term capital. Short-term capital, or also known as working capital. This part, the working capital part, we will park for now, and we will be covering when we take up corporate finance under part 2, section B, corporate finance. At that moment, we will be covering this short-term finance. Now our focus will be, as we discussed, which will be on the long-term finance. Again, coming back to the starting point, when we say investment decision, whatever we are investing, it is not for today, tomorrow, it is for a longer duration. So that is why we said investment decisions, capital budgeting, and now we are saying that under capital budgeting, long-term capital. I hope that point is clear. So let me summarize up to now. We started with part 2, investment decisions. Under investment decisions, we said also known as capital budgeting, 3 segments: basics, then you have methods, and then miscellaneous areas. Under basics, when we said the first part was capital, and we are subdividing that capital into 2 categories, long term and short term. And our focus now would be on the long term capital or capital budgeting. Now the next point. We said we are clear, we are moving ahead with long-term capital. What is its significance? Why long-term capital? Why we need to think about long-term capital? What is its significance? It is very simple. If you take a long-term capital decision, the impact of it is for a longer duration. Let's take a simple example. We are going to purchase a flat. If we go and purchase, let's say, 1 million invested on a particular flat, and we take a decision, okay, we are moving ahead and doing the registration. Once we do that, it is irreversible for a longer duration. You cannot reverse that decision. Once you take it, it is for a longer duration. That exactly is the significance of long term. It is irreversible. Once you take a decision, you cannot reverse. To give you some example, in early 2000 to 2006 scenario, there was a high boom in India, particularly on ERP implementation. As you know, ERP implementation involved multiple stages. Starting up, you have to have a due diligence, you have then your implementation phase, testing phase, then your maintenance phase. It's as good as a long-term investment. So when you look at from that long-term investment perspective, many companies who are doing well, doing really good, has taken a decision to move ahead to ERP decision without properly evaluating the impact of it. Investment decision or capital budgeting ultimately resulted in the companies itself shutting down. Companies were doing well, but a wrong decision in long-term capital investment resulted in companies shutting down. So as a result of which, it is most important that any decisions on capital budgeting or long-term investment has to be well thought, has to be detailed, analyzed before we moving ahead with that. To summarize, we can say that any decisions taken on long-term capital budgeting is irreversible, so we have to be very cautious about it. Now the next point is capital budgeting. We were discussing about capital. Now capital budgeting. What is capital budgeting? Why it is required? So if you look at, assume we have, there is something which is never ending, is our requirements, our needs. So when you look at from that point of view, unlimited requirements. If you look at from a company's point of view, there are n number of projects in pipeline. If you are looking at personal, individual's capacity, there may be unlimited needs for him. So always there is no shortage for that. At the same time, the fund required or the capital is always in scarce. So as a result, what happened? If you have 10 requirements, but the fund is available only to meet 5 requirements, we need to have something called capital budgeting. You need to budget your capital so that out of 10, you may be able to meet 5 requirements, because capital is always scarce. You cannot allocate the entire fund to meet your entire needs available, because it is available in scarce. So that is where the exercise of capital budgeting coming into picture. You are allocating the budget, allocating the capital to different projects. I hope that point is clear. Now the next is when we look at how we move forward to the next topic. As I said, the capital, we classify the capital budgeting 3 topics. The basic, what we covered now is the basic part of discussion. Under that we discuss what is capital budgeting, all these things. Now second is the methods. So before we move on to the methods, there need to be a bridge. Okay. Why it is required? Why we need methods? What is its significance? Why we need different methods in capital budgeting? So it is related to our earlier point. When you have long-term decision which has a risk involved in it, you need to take correct decisions to ensure that things go smooth. So if you need to do that, it is important that you do appropriate methods with which you evaluate a proposal even before you start the project. So that is why you have capital budgeting methods coming into picture. There are different methods available. So to name those under methods, we are going to the second part of it. Now basics, methods. To name those methods, one is net present value method, the most important method used by corporates to evaluate capital budgeting methods, capital budgeting decisions. Second is you have payback period, internal rate of return, then you have profitability index, accounting rate of return. Like that, there are different methods available for for decisions under capital budgeting. Now, our focus initially will be on net present value method. So even before we move into the concept of present value, it is important to understand an overview or outline of this particular method. So net present value method. So in case of net present value method, we will try to illustrate with an example where we will be able to give more clarity on that. We'll go back to our previous example of restaurant. What happens in that case? You are going to start a restaurant business today. You may be running this restaurant business for the next 40 years. So at this moment, somebody approaches you, yes, going to start the restaurant business for next 40 years, whether it is feasible or not. So we were saying the example of restaurant business for net present value method, wherein a person approaches us, today he is going to invest on this hotel business, restaurant business, and it is going to run for next 40 years. So as finance professional, we need to take a decision whether it is feasible to run this business. And we don't have a choice, it's for the next 40 years. We have to take the decision now and say whether it is acceptable or not. That is a question. So under net present value method, here comes two golden rules associated with this example. One is, you need to take into account the entire life cycle of the project. So when you evaluate from today, which is called as the 0 year, where you are going to make the investment, till 40th year, at the end of 40th year, you may be disposing, selling of that project, till that 40th year, whatever going to happen, you will be taking that into account. The entire 40 years cycle you are going to take into account. That is first point. Now, second is, here we are going to discuss about cash flows. We will be discussing only about cash flows. To be precise, expected future cash flows. So under net present value method, two golden rules. One is, take into account the entire life cycle of the project. From today, starting the business, then your recurring revenues and expenses each on year, and at the end of 40th year, what you are going to dispose of it. All these things we will be taking into account when we do net present value method. Second is, whenever we evaluate, we will be taking into account only the cash flow part of it. Non-cash flow expenses are not considered in this. So these are two golden rules under net present value method. So let's try to evaluate the flow. We said investment decisions or capital budgeting. Under capital budgeting, basics, methods and miscellaneous areas. Under basics, we covered what is capital budgeting, significance, all things we covered. Then we moved on to methods. Under method, we said net present value, which is the first method. And under net present value method, now we are indicating that, okay, under net present value, two golden rules to remember. One, we take into account the entire life cycle. Second, we are going to discuss about cash flows only. Non-cash flows are not considered, right? Now, we will be going further deep into it. One by one we will be taking it. So when we say entire life cycle, what we do here is, we will at next level, we will be further subdividing this entire life cycle into multiple segments. So the first part, the entire life cycle will classify into 4 segments to be precise. So the first part is called as 0 year. What is 0 year? Today I am going to invest. We are going to invest on that restaurant business. Cash is going to go out of my hand for today's investment, which is called as 0 year. Then the next part is, there is something called depreciation tax savings. I'll be elaborating that more as we progress. But remember that it is not depreciation. We are discussing about the tax savings which arose on account of my depreciation. So I invest on a building which may be depreciated over a period of 5 years out of the total project life. So this 5 years, as a result of depreciation is in place, I may be getting some tax savings. That is the part we are discussing now. Now, third part, you have recurring cash flows. Year on year, you have recurring cash flows coming in. So year one, you may have some cash inflow coming in from your restaurant business. You are selling something, you may be getting cash. You may be having some expense. You have to pay off your staff expenses, groceries, all these expenses. You may have some cash outflow. So the net of it, from year 1 to year 40, whatever cash inflows and cash outflow going to come, that we classify as phase 3. Then we have the last phase, which is called as the sale value. What is sale value? At the end of project life, after 40th year, we may be thinking of disposing of that restaurant business. I'm going to sell off that restaurant business. So I may be getting some cash flow. So that cash flows also take into account. I hope you're able to get an overview of it. So we are saying about the entire life cycle. Somebody approached us to evaluate a restaurant business. We said the entire life cycle need to be evaluated, and the entire life cycle we classified into 4 segments. One is 0 year, which is nothing but today's investment. Then you have depreciation, tax savings. The tax savings arose on account of depreciation, which I'll elaborate as I mentioned. So that is second part. Third is your recurring cash flows, year 1 to year 40. Whatever cash inflow, cash outflow coming in, that is called as recurring cash flow. And the final one is sale value, which is nothing but at the end of project's life we are disposing it off. So we are trying to take into account all possibilities which is coming in to take care of the entire life cycle. From today till 40th year it gets sell off, the entire life cycle is taken care under net present value method. Now the next step is we are going further deep into each of the segment. So look at the flow: investment decisions, basic, methods and miscellaneous areas. Basic over, methods, net present value method. Under net present value method, 2 rules. One is entire life cycle. Then you have expected cash flow only to be considered, 2 golden rules. Under entire life cycle we further break down it into 4 segments: 0 year, depreciation, tax savings, recurring cash flows and sale value. So also remember the term ZDRS, which is most important 4 terms, 4 letters you need to remember throughout capital budgeting. As we progress, whenever we going to discuss any questions, the first thing we write on the right hand corner would be ZDRS, which stands for Z, 0 year, depreciation, tax savings, D, R stands for recurring cash flows, and S stands for sale value. So we will be discussing about ZDRS as we progress, which is you need to remember that point. Now as we discuss one more step deeper into it, first one is 0 year. So when we discuss about 0 year, the 0 year is nothing but today at this moment. When I start business it becomes first year, but today when I make investment it is called as 0 year. So under 0 year there may be multiple scenarios may be coming into picture. There may be multiple scenarios. Let us evaluate one by one. So the first scenario is the person who approached us to start the restaurant business said he want to invest in restaurant business. It may be a straight case. He is going with maybe 10 million euros, $10 million. He go purchase some property and that's it. It is an initial investment or 0 year investment happens. There is nothing else exists there. You are investing, that's it. It gets over. Now the second scenario, this person assume that this particular person who is going to invest in that property or the building of that hotel have some old building available. So remember, this is important. Against this, we are looking from a project specific. We are looking only from a project specific. So for this project, this person is going to invest in this hotel, maybe purchase it. Let's to make it simple. So he is going to make a purchase of a land or a purchase of a building. So when he is going to sell purchases, he has some ancestral property available which can be disposed of against this project. So assume that he gets a situation wherein he has a situation, let's say he has to invest 5 crores in this particular property. Against that, he gets 3 crores from his old asset, the old asset, old building. So effectively what becomes his net investment? It becomes 5 minus 3, 2 becomes his net investment. So first scenario was he is going, let's say 5 crore he going and investing, which is a first scenario, which becomes a situation wherein he has only investment on the building. Second scenario is he is going to invest 5 crores, against he has 3 crores old asset sale happens, which become 5 minus 3, 2 becomes net investment. Now let's go to the third scenario, wherein you have to go and invest in asset. There is a sale value of old asset, the ancestral property also you are going to sell. So the investment you need to make is 5 crores. You have a situation, you have ancestral property which has 3 crores value. Ideally should have been net investment would have been 2 crores. But what happens here is government imposes taxes. Whenever you sell a property and if you derive capital gain out of it, then you will be liable to tax. So as a result of it, what happens, whenever there is tax happen, there is a cash outflow comes into picture. So under this scenario, we need to take into account the capital gain or capital loss. I will come to the capital loss later. Now let's elaborate on scenario 3, wherein initial investment 5 crores, sale of old asset 3 crores. Now when we say sale of old asset 3 crores, this sale of old asset, against that, assume that it has a net book value of 2 crores. So what we are saying, sale value is 5 crores, initial investment is 5 crores, you have sale value of 3 crores of old asset, against that there is a book value of 2. So how you derive capital gain? You have a sale value minus net book value, you derive at your capital gain or capital loss. So 3 crores minus 2 crores, you derive capital gain of 1 crore in this case. So again, net initial investment of 5 crores. When I sell this asset which is of 3 crores, I have to pay capital gain of 1 crore. So here we are discussing about sale value of old asset again, only then we will come to the net initial investment part. So sale value of old asset 3 crores I am getting, against that there is a capital gain of 1 crore derived. Now this 1 crore we need to identify tax. Assume for a moment our tax is 40%. So 1 crore into 40%, it becomes 0.4 crores becomes our tax portion. Now what we do? Against when the sale happens, I get 3 crores from the sale value. Against that there is some tax outflow which happened, which is 0.4. So as a result of which, what is my net sale proceeds? 3 crores minus 0.4 crores, I get 2.6 crores as my net proceeds from sale of this asset. So as a result, what happens? The overall investment which I made, initial investment is 5 crores, against which I have the receipts part from the old asset, I get 2.6. So 5 minus 2.6, I get the net investment as 2.4 crores. I hope it is clear. So we have covered 3 scenarios. Scenario 1, where there is only initial investment, only 5 crores you are going and investing, that is 1. Second is scenario 2, wherein you are investing, at the same time you have some sale from old assets. So you will be taking 5 crores as my initial investment, against that sale from old asset 3 crores. So the net investment required 5 minus 3, 2, which was scenario 2. Now under scenario 3, what we did, sale of old asset is there, at the same time there is some capital gain also involved. So we derived again sale value. What is my capital gain which I derived? We worked out the capital gain tax we pay, we reduce from sale value to derive net sale proceeds, which being reduced from my initial investment. So last example, 5 minus 2.4, it becomes 2.6 becomes our net initial investment. Now the fourth scenario, instead of capital gain, there may be a situation capital loss arrives. Capital loss arrives. What must be the possibility? Let's assume the scenario remains same. Initial investment is 5 crore itself. Your sale from old asset is 3 crores. However, in this case, what happened? Net book value, it become 5 crores. Earlier it was 2 crores. In this case, it become 5 crores. So what is my capital gain or loss? My sale value is 3 crores, book value is 5 crores, so the net becomes 3 minus 5 minus 2, which is my capital loss. Unlike earlier scenario which was capital gain, here it become capital loss. So as a result, what happened? Whenever there is capital loss, you don't have to pay any tax. Now there is a twist happens here. Let's take another example. Assume that you were supposed to pay some tax, capital gain tax for some other project, not for this project. Assume that you were supposed to pay 100, you have a 100 crore capital gain available there, 100 crore capital gain. Now there is a tax attached to it. If there is a capital loss in some other project available, what you could do is capital loss can be offset against that capital gain. So whatever 100 crores capital gain, if there is a 60 crore capital loss available, I could set off that 100 crores minus the 60 and only the net portion I need to pay. As a result of which, what happened? As a result of capital loss, my cash outflow towards exchequer, the tax payment, gets reduced to that extent. So we could relate to that example and say that if I have a capital loss situation, then I have a tax saving in some other projects within the company. So it is an assumption permitted under capital budgeting. Even if it is not specified about any other project, you can assume that if there is a capital loss which can be offset against some other project's capital gain, and as a result of which there will be a tax savings. So whenever there is a capital loss coming into picture, what we will do is we will be taking that into account and consider the tax savings portion. So the example which we were mentioning now, what we will do is,
let's go back to the example we were discussing now. We have sale value was mentioned as 3 crores, against which net book value was mentioned as 5 crores. So 3 crores of sale value, net book value of 5 crores, you get our capital loss as 2 crores. As we discussed, whenever there is capital loss which can be offset against some other projects which has capital gain. So capital loss of 2 crores, apply with 40% tax, 0.8 will be considered as tax savings. So tax savings will be treated as good as my cash inflow. So my sale value is 3 crores and the benefit which I get, 0.8, the tax savings which we need to add along with sale value. I hope that point is clear, because it is tax savings. It will be treated as cash inflow, which could be, as it is, could be offset against some other project. So 3 crores of sale value plus 0.80 which is of tax savings. So 3 plus 0.8, the net sale benefit from that sale of old asset is 3.8. So this 3.8 we will consider against my initial investment. Initial investment is 5 crores. Against that, 3.8 becomes our net proceeds from my sale of old asset. So what happened? 5 minus 3.8, the net investment become 1.2 crores. Hope it's clear.
So we were discussing about 0-year investment and its 4 scenarios. So let's look at the flow once again. We said initial in investment decisions or capital budgeting under part 2. Under that we said capital budgeting to 3 segments: basic, methods and miscellaneous areas. Under basics we have covered capital budgeting, its significance, long term, short term, everything covered. Then we moved on to methods. Under that we said net present value method, IRR, payback period, all these, accounting rate of return, all these things we mentioned. Then you have miscellaneous areas. So now under different method we started with net present value method, and under net present value method we said 2 golden rules, the entire life cycle to be taken into account, and then we discuss only about cash flows when it comes to NPV. Now further what we did, NPV, entire life cycle, we brought it into 4 segment ZDRs: 0 year, depreciation tax savings, recurring cash flows and sale value. Under that what we did, 0 year we further break down. See that 0 year we have 4 scenarios coming in. One is straight direct investment, second is investment with sale value of old asset, third is investment with sale of old asset with capital gain, and the fourth one was with capital loss. So we covered that 4 scenarios. Now the next is the D part, depreciation tax savings. So when we say depreciation tax saving, this is important to understand, okay? Earlier we said under NPV method we will be considering only about cash flows. So what is the place for depreciation, which is a non-cash expense, which is not a cash expense, it's a non-cash expense. Important point here is, though depreciation is a non-cash expense, the result of depreciation, inclusion of depreciation, result in some cash savings. Let us illustrate that with an example. Let's take a very simple P&L. So in that P&L, let's assume sale is 100 and you have expense of 50. So when you look at what is my net profit, 100 minus 50, 50 becomes my net profit. And we apply tax on it, 50 into 40%, tax is 40%, we get P&L, the tax portion as, how much it is, 50. 50 is my profit on which I apply 40. So I get 20 as my profit. Okay. Now the next scenario, what I do? I consider one slight change in it. Sale remain 100, expense remains 50, depreciation of 20 being added into that. Depreciation of 20 comes in. As a result of which what happened? My profit become 30. Earlier it was 50, it become 30. And then I apply tax on it, 30 into 40%, how much it become? The next 30 into 40% when I do it, I get a tax percentage, tax of 12 comes into picture. So as a result of it, if you look at earlier case, I was paying a tax of 20, which is 50 into 40%, 20. Now what happened? Because I added depreciation, what happened? It become 30 into 40%, which would become 12. In effect, ultimately, there is a reduction of $8 with respect to tax. So, which is nothing but the tax saving occurred on account of depreciation. That is what we call it as depreciation tax savings. So, though depreciation is a non-cash expense, by applying depreciation, we get some tax benefit, which is a cash saving that we need to take into account. Now the third scenario, recurring cash flows. So we discussed, is that 0 year we covered, depreciation tax saving with that example is clear. Now the third one is recurring cash flows. Recurring cash flows is nothing but year on year. So I have, as we start the restaurant business, there may be some cash inflow. Against that there is some cash outflow. So which is nothing but continuous cash inflows and cash outflow. So we will be evaluating those cash inflows and cash outflow during this phase, of course with net of taxes. We will be elaborating on each of this as we progress, but this is at a high level giving some summary. So the third scenario is recurring cash flows, wherein from year 1 to year 40 we will be taking into account the cash flows and cash outflow, cash inflows and cash outflows. Now the fourth scenario, sale value. So we said 0 year, today's investment we covered. Then we said depreciation tax savings, which is nothing but over a period of time depreciation is a tax saving out of it. Now the third is recurring cash flow. From after 0 year, year 1 to year 40 we considered entire cash inflow. Now what is left in that project life cycle is your sale value at the end of project life. At the end of project life, what do you do? At the end of project life, whatever you are going to dispose of it, the same scenario what we discussed earlier for sale of asset will come into picture, sale of old asset will come into picture. There may be a capital gain, there may be a capital loss. All these points we need to take into account when we consider the sale value at the end of project's life. Don't get confused with initial, at the time of initial investment we said sale value of old asset. But here we are discussing about it. Today whatever we invest at the end of 40th year when we dispose of it, what should be the cash inflows or cash outflow? That is the point we are discussing. So that point is called as sale value. That is what our ZDRS. So to summarize, we discussed under capital budgeting, under methods, we have under further again entire life cycle, and entire life cycle we classified into ZDRS. Z stands for 0 year, 4 scenarios coming in. D stands for depreciation tax savings. With that example it was clear. Recurring cash flow is nothing but year on year cash inflow, cash outflow, that comes into picture. And finally the sale value, which have again capital gain, capital loss, all those will come into picture. So now ZDRS is clear. One more additional point you need to remember is working capital. So let me, going back to the earlier example of restaurant. See, we were discussing about restaurant, initial investment, investment on the building, everything we covered. But to kick off the business, to start the business, you may require a few funds. Maybe I'll bit more elaborate on that. So with that heavy investment, you purchase building, furniture, everything is ready. But maybe to start the business, you need to have the first day's food. assume, or the first week food you need to serve. For that, you don't need a heavy investment, but you need some fund, which we call it as working capital. That is required. However, once the working capital, brought into the business, what happened? It run in its own. You are bringing the working capital, it starts, and then the revenue comes, that cycle moves on, and you don't need that fund anymore. It keeps running. So what we do is, at the beginning of the project, 0 year, we bring this working capital, which is required. And also, as the project moves, maybe 5th year, I may have an additional working capital required for maybe some enhancement of business. So that may be required. And whatever, as I mentioned, this working capital we introduce, it will continue. And after a point, the business run in its own. The working capital need not require. As a result of which, what we do, at the end of project's life, what we do, whatever we invested as working capital, we can take back those working capital. So initially or during the period, whatever working capital we invested, which become cash outflow for me, at the end of project's life, I will be able to take it back, which will become a cash inflow for me. I hope the point of working capital is clear. Now, the next is how we practically approach a question. So whenever in CMA topic, when that capital budget topic comes into picture, it is important to understand that you have a question of objective type, wherein you may not be given a question to identify maybe the entire life cycle. It's a pretty big question where if you have to cover ZDRs completely. So on the other side, for objective questions, what generally the exams being asked, specifically like, okay, first year, what is the cash flow? Second year, what must be the cash flow? Or 0 year, what is the cash flow? Or at the project's end of project, what is the cash flow? So they will be specific on any of the particular period to derive the cash flow, which makes more sense because you objective type, you cannot do the complete NPV exercise. I hope you're with me. I hope that is clear. Now here, when we say NPV, first let me explain about the NPV part again at a macro level. We said the entire life cycle wherein ZDRS is involved in it. So we will assume $10, 0 year. Then you have cash flows coming in year on year. Let's say, to simplify it, let's say 10 years, 10-year project. So you have $10 as your 0 year investment, and assume that year on year you have $5 each as your cash inflow for next 10 years. So it becomes 50 becomes your cash flow, which is on account of recurring cash flow. So 50 is my cash inflow, recurring cash flow. 0 year is 10 cash outflow. Depreciation tax saving, assume it is another $20 or another $5 or take it $1. Depreciation tax savings $1. So what happened? 50 becomes my recurring cash flows, 1 become my depreciation tax savings, and 5 becomes my cash outflow. Now sale value, assume for a moment there is no sale value. So what we do is, we will take into account the overall summary wherein you have 50 as your cash inflow on account of recurring cash flow, or then you have depreciation tax savings 1 against cash inflow, 50 plus 1. Then you have cash outflow of 5 against that. So 51 minus 5, 46 becomes my net present value. Present value we have not come to that, but for this calculation purpose, NPV becomes 46 in this case. I hope that clear. So this is more at a very macro level, at a very high level with a simple example I was trying to say. But as we progress, we will go into deeper, lot of things to understand. But at a nutshell, I can say that ZDRS, we will take into account the consolidate all cash inflow, we will reduce all cash outflow and derive at our net cash flow position. That is what the net present value method. When it comes to objective question, the entire NPV cannot be asked because it becomes very lengthy. So it will be specific for a particular project. You will be considering only for a specifically for a particular period. So wherein what we do, we identify for a particular, let's say this is 0 year. We will calculate under 0 year what all will apply under ZDRS. Or let's take year 1 cash flow. So the first thing what you will do is you will write down ZDRS. So and then see, okay, is that when you are calculating year 1 cash flow, whether 0 year will apply? No, it will not apply. Why? because it is relating to 0, Z stands for 0 year. 0 year, it is not applicable. For overall NPV calculation, it is applicable. However, if a question is on year 1, it is not applicable. Why? Because under year 1 calculation, your 0 year does not come into picture. So you will write down ZDRS and then say, is it not applicable when we calculate first year calculation? Depreciation tax saving. Yes, if depreciation is applicable, tax saving is available, then that will be available. Take. Then recurring cash flows. Yes, year 1, there is a possibility of recurring cash flow available. Take. Then finally comes to sale value. Sale value may be at the end of project 5 years or 50 years. So those cases, when you are calculating year 1, that may not be applicable. So you will again do not applicable. Cross it. Okay. So when you calculate year 1 in this example, it may be only depreciation tax savings and recurring cash flows may be applicable. So you will calculate what is my cash inflow from recurring, you will calculate from depreciation tax savings, total it, and that becomes your cash flow for that particular year 1 proposal. I hope you get the way to approach the question. Two scenarios may come. If it is a descriptive, it may be a complete NPV question, wherein the entire ZDRS for the entire life cycle you will be taking into account. When it comes to specific for a year, which is likely for the objective type, you will identify ZDRS under which all category applicable, will take only that and calculate year 1 calculation or the respective period which is being asked. Now we will move on to specific questions wherein you will understand whatever theoretically explained so far will be more clear and will be able to appreciate how we need to approach towards questions. And the questions being considered more or less in line with the previous exam models. So questions has been considered so that you get a feel that okay, these are the kind of questions which will be coming in exam.